Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending July 15th, 2023. I'm Preston Brent, back from 2 weeks off. Thanks for tuning in. I had to move my offices and a few other things and just been very hectic, but everything worked out very well. So why don't we take a look at where the markets have been and where they possibly could be going. Um, Again, the theme this week is obviously give me breath, and that's pretty much the theme when I left to start my move a few weeks ago. So let's go take a look at things and just see how they're shaping up. So if we look at the US markets first, you can see everybody was up strong for the week. Over 2% for the Dow and S&P, Nasdaq and Russell up over 3% year to date, knocking the ball out of the park. The Dow was lagging, of course. If we look at it, the S&P is only about 6.5% below its all-time high made last January 22. Nasdaq is a little more than 12.94% below its record peak made in Q4 of 21. But I want everybody to note that this first half of the year, only about 1% of the stocks drove 80% of the gains, and the normal when you have strong up moves like this is around 40 to 50% participation, normal. But this limited breadth is going to have an impact on the markets if a lot of these laggard stocks cannot play catch up, right? Meanwhile, if we look at the best sector for the week, discretionary, worst energy, and if we look at the annual sector performance year to date, you can see it's the exact opposite of the way it was in 22. Technology leading the way at 23.67, energy bringing up the rear at 23.45, almost diametrically opposed to each other. If we look in the upper right-hand corner, you can see the forward PE ratios, very robust 20.37. I think that's a little bit rich. I do believe we're going to pull back a little bit in the second half of the year. We'll finish in the green for the markets, of course. But the second half of the year clearly is not going to be as strong as the first. You can see the dividend yield at the S&P is at 1.55. 10-year Treasury is about 227 bips higher at 3.82. Earnings yield for the S&P is coming in at about 4.85%. All I did was take an estimated 12-month go forward earnings per share for all of the S&P at around 220. And that's kind of where we've been stuck for a while as an FYI against the S&P. And that gives us that earnings yield of 4.85. Now, the yield over the 10-year Treasury is 103 bips, 103 bips, 1.03%. The real yield is a positive 1.85 because inflation came down to 3%. So with an earnings yield of 4.85 and inflation at 3, then there's just a little bit of a growth there from that perspective. The VIX down over 17% for the week. It came in at Friday's close at 13.34. The prior week it was at 16.08. So all in all, a very strong week for the U.S. equity markets. Now, of course, if we come over to Europe, you'll see also just about everybody, well, actually everybody was in the green across Europe. You can see Euro stocks, FTSE, CAC 40, DAX, all of them solid in the green year to date and as well as weekly. So we're having a pretty good, robust start to the year. The only countries that are having difficulty is China and Hang Seng on the Asian markets. But if we look at it over in Europe, we look at the minutes of the ECB. Like the Feds, they're looking at raising their rates at least once or twice. The UK economy, the GDP, on a rolling 3-month basis is only at 10 basis points. So it's, for all practical purposes, it's fairly flat, okay? Now, and if we go over the Asian markets, Japan, they're lagging some of their peers. You can see the Nikkei was flat for the week, but look at it year to date, 24%. I haven't seen the Nikkei perform like that in decades. That is a huge move for Japan on a year-to-date basis. Now, there's also growing expectations that the BOJ, the Bank of Japan, is going to adjust its yield curve control framework, the YCC, that they limit their interest rates. And what that's going to do is have a net positive or a bullish effect on the yen. All right, so that's a trade that our members we want to start looking for, because it'll be a nice long trade should that thing have effect. Meanwhile, over in China, you can see they were up a little bit for the week, but only 4.81% year to date. Hang Seng strong for the week, but still in the red. The only country in the red that we follow there. China's having a really bad time on their economic front. You know, their CPI remains unchanged in June from a year earlier. Their core inflation is about flat. Their PPI slipped lower than expected. So inflation's clearly not an issue there, which means they're going to be pumping more money in the economy. There is deflation risk in China right now, kind of like what we're seeing here in the US just a little bit as inflation falls here in the US. Same thing in China, but more aggressively so in China. We're also seeing Chinese exports fall much larger than expected, 12.4% in June. That's big from a year earlier. In fact, that's the sharpest decline China has in their exports in over 3 years. Now, remember, China sells to the U.S. and Europe, so that could be a canary in the coal mine for where we're going to end up in another 6 months or so. Right. Meanwhile, imports in China shrank 6.8%. So the Chinese consumer is also feeling the pain, and they're not doing a lot of buying either. So I think I see the economy performing in the green for the second half of 2023 here in the U.S., but it's not going to be anywhere near what it did in the first half, right? And I do see a little bit of a potential pullback in the August, September, October timeframe, and then a flourish finish to the end of the year. So let me just shift my screen a little bit. So just bear with me 1 minute as I move my screen around here. Let's get over here like this. Let's do this. So as I move my screen over here, you're going to see the E-mini S&P 500 futures come up. And we're looking at a daily chart, of course. And what I want you to focus on here is we hit a 2023 high on Friday. But if you look at that candle, it's almost like a shooting star kind of candle, all right? And those traditionally show that the markets are petering out. So as I blow this up, you can see this candle right here, which would suggest a little bit of a pullback. Now, this is an Elliott wave through. We got some divergence in here, so I would not be surprised to see a pullback of at least 100 points in the S&P over the next 3 or 4 weeks. Now, we're in a strong momentum game, so we can still continue to run up a little bit. Notice this gap up here. 4,300 would be my natural pullback point, all right? And there is a 43.75 pullback point and another one at 4,400 as well that we could pull back to. You can see my system's even calculating a potential Elliott wave 4 pullback down to 43.62 roughly. So I do see that in the works, but keep in mind momentum can continue to push us up just a bit more. So we've got to watch that very closely. Okay. Nasdaq also hit a 2023 high on Friday, but again, like the S&P, a little bit of a doji, or the candle is going to appears to be like it wants to pull back a little bit. You can see I have calculated using Gann and Fibonacci potential pullback points even in the Nasdaq, all the way down to 14,139. Now we're at 15.6, 15.7 roughly. So it's a nice little pullback of about 1,500 points. But I would see that sometime over the next 90 days, okay? I would consider that to be more normal. Clearly, a test of this gap up, like the S&P, down to 14,500 makes sense to me. Okay. Now, if we look at the equal weight SPX, we take that breath out. You can see it is up nicely, but not a lot, right? This is up about 8 or 9% for the year, which is normal for a normal index, but this is the equal weight SPX. You can see we were in the red here all the way up until about June the 2nd, right? And then through June and then to halfway through July is when we made the big run in the equal weight index of the SPX. So that's kind of what I'm seeing there. Now, if we come over, let me just move this around a little bit. Let's go take a look at volatility. If we look at the VIX, we're kind of hovering in the green area here, right? Now, we haven't been down here for 2 or 3 years, right, since COVID really started. And when we get down here, the odds favor dramatically of move back up into the yellow zone, which runs from about 15 to 20. Okay. And I would not be surprised sometime over the next 90 days, we get a little spike back up into the mid 20 area. I don't think it's going to be any sign of impending doom, but I do believe there's going to be some serious profit taking in the next 90 days in these markets. Because if we get profit taking in technology, and in addition to that, these laggards, the other 99% of the stocks kind of just run flat, and they don't pick up the volume and the gains if the tech stocks really pull back, those 7 or 8 stocks that account for most of the gains. Then we're going to get that 5 to 10% pullback, right? And that would be normal before we have a strong finish to the end of the year. So this would give me an area where the VIX would kind of move back up. I would not be surprised to see that. Okay. And of course, if we look at treasuries, you can see here the bond market finished down on Friday. It's moving up just a little bit. The bond market is essentially saying we're going to have a recession sometime in the next 9 months. And you're seeing that the Feds are saying they're going to hike the rates 2 times. There's about a 90%, 85, 90% chance they're going to hike the rates in 2 weeks, another 25 basis points. And then the markets and the bond market is essentially saying that's going to be at one and done. So we're at the end or near the end of the rate hike cycle. And then they're going to be forced to start cutting the rates towards the end of this year, early next year, several times. The Feds are not on that storyboard. Feds are saying they're going to leave the rates higher for longer. So one of these is going to win and one of these is going to lose. And if the bonds win, then that means we're probably going to have a little bit of a recession before things kind of clear up. If the Feds win, then interest rates are going to stay higher. We'll run a little bit more sideways chop for a while before we get a little bit more clarity in what the Feds want to do. Okay, so that's a little bit about that. And if we look at the 10-year interest rate right here, you can see here that it is, and if we just back out a little bit, this was my original target right here. We came up to 4.33. We're right back at my original target. So let's call it 3.68, 3.7. We're going to hover around here for a while. You can see we started moving up off the lows here in April when the market started to believe that, yes, the Feds, in fact, will hike again once or probably twice. That's what the Feds are saying. And that's jacked the rates up, which have moved the bonds lower. Okay. So that's a little bit about where we're seeing what I'm seeing in the bond market. And of course, if we look at the dollar, this is going to be a good trade over the long period of time. The dollar's made new lows. I haven't adjusted my chart, but you can see we hit my target for the dollar down here like this, right? So once I adjust, the dollar will be down a little over 3% for the year, which is a lot for the dollar. But you can see this fall off the table, right? When inflation data came in, we got the annual increase headline at 3%, and the core slowing to 4.8%, right? Now, remember, core is what the Feds want at 4.8%. So the Feds are probably going to hike again, but that's weakening the dollar. The dollar is coming down, which may put some strength in the precious metals market, gold and silver, and possibly in some of the commodities, right? But when the dollar's down, other currencies are up. And if we look at the euro, you can see the euro here is moving up nicely. Now, my target was right here, and it just moved right up off that right here, right? And I've got to adjust this as well. So the euro is at 112.64. My target was around 111.66. So we're blowing right through it. Typically what happens on these currencies, it'll blow through my target, come back and test it and take off again, right? But we've had a couple of good entry points and longs in the euro. If we look at the yen, I think if the Bank of Japan does what they say they're going to do, the yen is going to be off to the races. Over here, the estimate was that they were going to do it back here, and you saw what happened to the yen. And then when the new Bank of Japan governor came in, he said he wasn't going to do it at that time, and then it just fell off right in this area right here. So I think it's going to work its way back up into this area again. So being long the euro or being long the yen makes a lot of sense to me, right? And members, we'll go through this in our weekly market watch Sunday evening. And of course, if we look at gold, with a weakening dollar, gold's going to catch a bid. You can see gold's kind of moving back up. I think gold will come back up and challenge this area up over 2,000. We're at 1959 roughly right now, but I think it'll challenge 2,000 relatively easy. The Elliott wave count suggesting it's going to come up and roll back over again. If that does that, that means we could be in a recession. The dollar's getting a lot stronger, so we have to. There's some conflicting signals out there. If we do get a recession this year, then a lot of these stocks are going to be down 5 to 10%, and we're going to see the dollar get stronger, right? So we just have to follow where the Feds are going to take the action. Now, understand, earnings have already kicked off with the banks. They did very well, but we've got a lot of earnings coming up this next week, over the next 3 weeks. Earnings are forecast to come in a negative 6.4% year over year, right? Even though the revisions have been revised higher, we're still negative for earnings. And pay close attention to the forward guidance. That's going to help drive the U.S. equity market. So this is something that we got to follow very closely. Okay. And then, of course, if we come down here and look at oil, oil has moved up to the mid 70s on the OPEC cut in production, but we're still in the red for the year, as I said earlier. And you can look here that I think it's going to be a nice trading range, and we've got great trades for this. So for members, I'll review this with you guys Sunday evening as well for oil. And then, of course, if we look at the nat gas market, nat gas has been hovering down here for quite some time. Just a great trade for us, selling puts out of the money or doing our flies in a unique way that we do them. Again, it's just money in the bank if you understand how to play them. All right, everybody, that's a little bit about where we're sitting right now. Members, I will see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in and play with us. Any one of these trades will pay for the membership for the year and put money in your pocket, which really at the end of the day is what you're looking for. All right, everybody, have a great weekend. Members, I'll see you Sunday evening at 8 p.m. Eastern Standard Time. Ciao, folks.